If you've been waiting for mortgage rates to move before buying a home or refinancing, there's something happening right now that's worth paying attention to. The U.S. Treasury just announced plans to buy back more long-term government debt. And almost immediately after the announcement, some longer-term interest rates started coming down. Why does that matter to you? Because what just happened could put some downward pressure on mortgage rates. It doesn't mean rates are guaranteed to drop, but it is a positive sign for home buyers and homeowners who've been waiting for a better rate. There are three things you need to know about what's happening. And the third one is probably the most important if you're thinking about buying or refinancing. First, what did the Treasury actually announce? So starting September 9th, 2026, the Treasury plans to increase how much longer-term government debt it can buy back. You don't need to understand all the bond market details here. The simple version is that the Treasury is becoming a bigger buyer in this part of the market, and more demand can help push longer-term interest rates lower. We saw some of that right after the announcement. The 10-year Treasury rate dropped from about 4.71% to about 4.67%, and the 30-year dropped from 5.28 to 5.21. Those might not sound like huge moves, but they happened quickly. So in plain English, the Treasury just gave longer-term rates a little push in the right direction. Second, what does this have to do with your mortgage rates? A lot of people think mortgage rates only change when the Federal Reserve changes the rate. They don't. Mortgage rates can move based on inflation, the economy, and what's happening with longer-term interest rates. So if these longer-term rates keep coming down, mortgage rates could improve too. But could is the important word. This is a positive sign, not a guarantee. And if you don't want to follow this stuff every day, that's exactly why we created the Morgan Financial Rate Tracker. We watch the market and break it down into what actually matters to you. What changed? Why did it change? And what could it mean for your mortgage rate? You can join free using the link below. Now, you might also hear people asking if this is basically another version of quantitative easing, or QE. QE is something the Federal Reserve has used in the past to help bring longer-term interest rates down. What's happening now isn't exactly the same thing, but I wouldn't get too caught up in the technical differences. The important question for you is whether this could actually help mortgage rates or not. And yes, it could, but again, there's no guarantee, which brings us to number 3. Should you refinance right now? Maybe. But instead of trying to guess the exact bottom in the mortgage rates, figure out what rate makes sense for you. What's your current rate? How much do you still owe? What would refinancing actually cost? And how long are you planning to keep the home? Our refinance calculator can help you compare the potential savings from the cost of refinancing. And if the numbers don't make sense yet, that's okay. At least you know the rate you're waiting for. Then you can let our rate tracker help you watch for that rate instead of checking mortgage rates every single day. So here's the bottom line. What the Treasury just announced could be good news for mortgage rates, but it doesn't guarantee rates are going to keep falling. If you're thinking about buying or refinancing, don't worry about perfectly timing the market. Figure out the number that makes sense for you and be ready when the opportunity comes. Join the free Morgan Financial Rate Tracker and try our refinance calculator using the links below. And let me know in the comments, are you watching rates to refinance, or are you waiting for rates to come down before buying your next home? We'll keep watching the market so you don't have to. Morgan Financial is here to get you locked in.